As you all know, bears usually hibernate during the colder months, but on Wall Street, this red-hot rally has some bears coming back to life. Our next two guests are worried the record run could soon turn around and bite investors. Carter Worth has been clawing away at the technicals, but we begin with Joe Zidle. Blackstone's chief investment strategist says S&P 500 year-end price target implies a 7% drop from current levels. Joe, welcome.
Thanks for having me.
Happy Veterans Day. You are a veteran yourself. So.
I served U.S. Army Reserves, 6x2 enlistment, so 6 years of active reserves plus 2 years of IRR. So thank you, and I have an enormous amount of respect for everyone who puts on their uniform every day.
Absolutely. Thanks to all who have served our country. Let's go behind this 7% drop prediction. What's going to fuel this?
I think, we've had a year where liquidity has absolutely overshadowed fundamentals. We're up 23% year to date, and that's in the context of near zero earnings growth. In the first 2 quarters, there was no earnings growth. This quarter, earnings growth looks like it's going to be negative on a year-over-year basis. And the fourth quarter doesn't look much better either. And that's also in the context of profit margins that have begun to roll over and revenue growth that's sort of slowed to a crawl. So all in all, we've got this environment where the market's gotten way over the tips of its skis. And I don't think this is the end of the bull market. I think we'll have time left in this rally before the expansion comes to an end. But I think there's going to be better entry points.
So Warren Buffett's got $122 billion sitting around. His main indicator, that Wilshire 5000 over GDP, it's like 146% in terms of Wilshire 5000 market cap over GDP. He's clearly seeing something. Does that factor in? And you mentioned earnings growth. I mean, this is going to be the slowest earnings growth, I think, in 4.5, 5 years. I mean, at some point, it has to matter, right?
I think so. And what the Fed has done, they've recreated this Goldilocks scenario, right? Not too hot, not too cold. They're not going to cut, but they're not going to hike. And if you think about all the liquidity that's been created by the Fed and other central banks around the world, it's gone into financial markets. It hasn't really gone into, the real economy. If you look at the first 3 quarters of 2019, GDP growth in the United States is about $400 billion, yet we've added like $6 trillion to our market cap. So, investors have pumped money into the stock market, into financial assets, but I think we need to take some time to let those fundamentals catch up. Typically the last leg of an economic cycle is generally going to be the best leg, so maybe growth would actually accelerate from here. I don't really know. I'm not all that optimistic on growth, but I just think that at some point we either have to have this earnings growth catch up. It doesn't look to be the case, or we have to have prices fall, and I think it's going to be prices falling. It might be a correction in the context of a still secular bull market. This is the longest bull market in history. We're not yet the largest. We have to go through 3,300 in order to be the largest bull market. My guess is we'll eventually hit it. I just think we're going to see some volatility, and we've got to pause.
So you talk about this, where we are now in terms of pricing fundamentals versus last year. Interest rates were a lot higher this time last year, right? Significantly higher. So putting that into your model, though, that should have PE multiples be somewhat higher than they were last year.
Expanding, right. Think about it. It's a tug of war between, profits or some form of profits and interest rates. We started the year with a 10-year Treasury at about 2.4%. Today, we're back at about a 1.9, 1.95% level. And, I think one of the unintended consequences of the Fed's Goldilocks scenario is they have given, the 10-year Treasury sort of like a green light to move higher from here. In other words, I think we see a steepening of the yield curve. That should be good for cyclicals, but it also means the 1.5, 1.6% that we saw in the 10-year Treasury, I think those are the lows for this cycle. I think the yield's going to go higher, and that could pressure valuation. We've got a market that's trading at 20 times trailing 12-month earnings, and that's in the context of not a lot of earnings growth. So I think there will be winners. I think there are areas that, we'll be able to step into and buy. But right now, the market's really concentrated. The top 10 largest companies, the S&P 500, are about 22, 23% of the market cap of the entire market. And, your healthiest markets are the ones that are really wide in breadth. But this is one that's pretty narrow.
And just quickly, you like small caps?
I think small caps are probably one of the most under-owned parts of the market. Yeah. The Russell 2000 hasn't hit new highs the way all these other asset classes have. And I think if we do get this trough in earnings, and if we do get this one last profit cycle before the economic expansion ends, then you ought to see that reflation in small caps. Small caps are more protected from trade because they're more domestic, and they're probably more exposed to the Fed interest rates at these levels. So I think overall, small caps could be that positive.